No, she means to say.
Alright guys, so welcome, we're your finance chairs. So today we're going to give an introduction to equity analysis and basically how to pick stocks. Because today we're going to start the stock simulation game. So all committees, every committee member is going to play, and there's going to be a winning committee at the end of the semester as well as an individual winner, and chairs will be playing as well. So we want to just give you guys kind of an overview of what we would do when we're selecting stocks. So today we're going to talk about what we would do for analyzing Apple. So the first thing you want to do when analyzing a company is you have to make sure you understand the business. The best way to do this is to go to the SEC website, the Securities and Exchange Commission, and look up the 10K filing that a company submits each year. Now this filing includes information on a company's products, competitors, trademarks, patents, and it can give you a very good overview of how your company generates its profits, who are its main competitors, what could be some of its weaknesses, what are its plans for the future. And we chose Apple today because everybody has a pretty good understanding of Apple's products. But if you're analyzing a company and you don't know much about the industry or company, you really have to do this step thoroughly before moving on. So next, you want to do an industry analysis to determine how competitive your company is compared to its closest rivals or similar companies. And the way to do this is we're going to talk about Porter's 5 forces, which is a method to determine the competitive intensity of a market and therefore the attractiveness of investing in a company within that market.
So the first part of Porter's forces is threat of substitute products. When you look at a company, you also need to consider the products that competitors are making. So in this case, if you look at Lenovo, they recently released a laptop that has a touchscreen. You flip it back and you can basically use it as an iPad. So you should ask yourself, can that combination replace both the MacBook and the iPad? And if it can, then does Apple still have the competitive advantage in the computer industry? The other part is the threat of new entrants. Can new competitors break into the industry that Apple is currently dominating? So there are a lot of barriers to entry to this. So for example, brand loyalty. Whenever Apple releases a new product, you can see like a long line outside the stores. And that's because there are a lot of customers waiting, like just dying to buy the product on the very first day that it's released. There are also large startup costs. It takes a lot of money to buy all the machinery, to build the factories, to build computers. So that's something that startup companies usually can't raise enough money to meet those large startup costs. But there are also opportunities for new competitors. So for example, Macs are very expensive, as you may know. So it's possible that new competitors, they might start at the bottom, at the lower end of the market, and then gradually work their way up to be able to compete with Apple. The other part of Porter's forces is bargaining power of buyers. This isn't really a problem for Apple because of brand loyalty. Apple can pretty much charge any price it wants. So as you can see from this pie chart, in a recent survey of iPhone 4 buyers, 77% of them said that their last phone was an iPhone. So it shows that Apple customers, they don't really switch from an iPhone to a Nokia to a BlackBerry. They just stick with an iPhone.
Okay, so next we're going to look at bargaining power of suppliers, which also isn't too much of an issue for Apple, because since Apple commands such a large percentage of the global market, it basically has leverage over its suppliers because of its economies of scale. So the suppliers for Apple generate most of their business with Apple, maybe 60–70%. So if they were to lose Apple as their customer, their business would suffer. So if Apple requests a price that's maybe lower than what they want, they really have to go with that price anyways because they don't want to upset Apple. So it really has a strong leverage over suppliers and can get the prices for supplies that it wants, while lower new startup companies don't have this advantage.
So we're going to start going over different financial ratios you can use to analyze a company. The first one you've probably heard of is PE ratio. You take the price per share divided by earnings per share. So in general, the higher the PE ratio, then it means that investors expect the company to grow more. The lower the PE ratio, then it means that investors expect the company to grow less. So in general, for a high PE ratio, it means that investors are willing to pay more in terms of price for the same amount of earnings per share. They're willing to pay a premium for the company.
And we're going to send a review sheet with all this information. Okay, so next is PEG ratio, which is the PE ratio over the earnings per share growth, the projected growth. Now, if you have a PEG of less than 1, it generally shows that the company might be undervalued because relative to its growth, it has a low PEG. So basically the growth is very high compared to the PE ratio. And you always want to compare PEG ratios with companies within the same industry.
So you look at this chart, you'll see that Dell has a lower PE of 9, and Apple has a PE of 10. So it suggests that Dell is relatively undervalued compared to Apple. So whenever you look at any financial ratio, a PE of 10 means nothing. You have to compare that ratio with the financial ratios of its competitors, of the industry average, or of the overall stock market.
Alright, so this shows the competitors, it shows the PE and PEG ratios. This kind of chart can be found on websites like Yahoo or Bloomberg, and you want to make sure that when you're analyzing the company, you look at its competitors. Most of these websites have a little section for direct competitors. So you'll notice that when you go here, you notice that Apple has a higher PE ratio and a lower PEG. So the lower PEG indicates that relative to its growth, it's possibly undervalued compared to Dell.
So let's go over some profitability ratios. Return on assets is net income divided by assets. Assets is the sum of money that the company has borrowed, plus the sum of money that the company has taken in from stockholders. So it's a measure of how well the company is doing, how much profits they're making given a certain amount of resources that investors put in the company. Return on equity is the same thing as ROA, except instead of assets, you have stockholders' equity. Stockholders' equity is the amount of money the stockholders has put in the company. So it's just ROA, but you take out the debt part of it.
Okay, so if we're going to analyze the ROA and ROE of Apple, first we'll look at how high the numbers are. Obviously, a higher number indicates that they're generating more net income given the capital they have. One other thing you'll look at, though, is the ROA is about 20%, while the ROE is 38%. Now, this difference is expected since assets includes debt, so it's probably you expect it to be a bigger number. But let's say that ROA was 10%. That shows that this bigger difference indicates that maybe Apple isn't using the debt it receives effectively. Maybe it's taking on more debt than it should, they're just not using that to generate more net income.
So debt to equity ratio. Debt is the amount of money the company has borrowed divided by equity. Equity means ownership. In this case, ownership in the company. So it's the amount of money that stockholders has put in the company. So in general, a higher debt to equity ratio means that the company is very reliant on borrowed money. And that could be a bad thing because they have to pay more in interest, which would increase the cost and reduces their profits.
Okay, so we have a question for you guys. If Company A and Company B have the same ROA, but Company A has a higher debt equity ratio, how do their ROEs compare? So think about what the difference between ROA and ROE in terms of the denominator.
Which one should have a higher denominator, and which one should have a lower denominator? ROE or ROA?
Who's financing here? Someone finance.
Well, okay, so asset is equity. Asset is equity plus debt. So if they have the same ROA, then the return is the same, and then the ratio is the same, and then so A has a higher debt and equity ratio. That means the percentage of debt is higher, and then the equity is lower. So ROE, the denominator is equity.
Yeah.
So it should have a lower, higher percentage for company A.
Yes. Do you understand that?
Do you understand that?
There you go.
So basically, ROE will have a lower denominator than ROA. Both company A and company B have the same fixed amount of net income. You divide the numerator by a lower denominator, then the overall fraction goes up. So that's why company A has a higher ROE.
Okay, so now we'll look at current ratio, which is your current assets over current liabilities. So current assets is basically the cash that you're expecting to generate within, say, a short period like a year, while current liabilities is what you have to pay off within the next year. So if you have a current ratio of less than 1, then generally the company, it's riskier to invest in that company because it shows that the company is not generating enough cash flow within a short period of time to pay off its short-term debt obligations. So if that continues year after year, the company will be failing to pay off its debt, and that can be very risky.
So let's look at the recent news that the New York Times has reported last month. So Apple reported its earnings, Q4 earnings, so profit of $13 billion. It sold 20% more iPhones, sold 48% more iPads, but its stock price dropped 11% when Apple announced its really good earnings. So why would that happen? Well, it's because stock analysts expected too much out of Apple. They expected even more sales in iPhones, they expected more profits, they expected more sales in iPads. And Apple did not meet those expectations. So as a result, if you look at the 1-year performance of stock price of Apple, it dropped from 700 to 400. So the last question is Apple overvalued? is that why the stock price dropped so much in spite of continually increasing earnings. Whenever you look at a stock price, if Apple stock price is $700, it doesn't mean that Apple is doing well. It just means that investors expect Apple to keep making more money, to keep growing. But if Apple doesn't meet those expectations, then the stock price will drop like a lot, by 11% in one day. So that concludes our presentation.
So later today we'll send out an email on how to sign up for the simulation game, and everybody will be playing and competing with committees and individually, and it will have a review with all the information, like the ratios we went over, because we went kind of fast. But any questions or anything? No?
So if higher stock price doesn't mean that Apple's doing good, then what's the, let's say what's index, what's the data you're looking at to see how Apple's doing?
Basically, so what he's saying is that if you're trying to analyze Apple, you'll try and determine whether you think, because the stock price doesn't show that it's doing well, it just shows that investors are really expecting a lot. So when you do this analysis, you're trying to determine whether or not whether you think that it's overvalued. So since it dropped so much now, you can still invest thinking that maybe Apple's going to increase products and still do well, or you can think that it's still overvalued and that it's not, in terms of competition or innovative products, that it's going to continue to decline and do poorly.
So you might have noticed that people might say because the stock price went up by 10% that you should buy it. That's actually a really terrible reason, because you don't know whether that stock price will keep increasing that much in the future. Yeah.
What do you guys think about Apple? Like, do you think it's going to turn into like a Microsoft where it just stabilizes, or do you think it's still like overvalued?
What do I think? I think that because of that laptop by Lenovo I just showed you, it shows that I think that Apple, their products, they aren't very new. They aren't very on the edge, have a competitive edge anymore, unless they continue innovating. And we still have to see whether Apple can still continue to do that.
And one thing we didn't go over a lot, but we'll just mention because we have time, is one method that we've looked into for analyzing stocks is like Warren Buffett's method. And one thing he stresses is if you don't understand a business, like a certain aspect, you shouldn't invest in it. So Apple, he claims, and I agree, is that Steve Jobs was kind of this variable that you don't know how he affected their profit and their company. So then, now that he's gone, it's hard to determine whether they'll have that competitive advantage and be able to keep creating innovative products. So I think it's very risky to say invest in Apple or expect it to increase. It may stabilize, but I don't think that they have the competitive advantages they could, or I don't think we can predict it, so it's risky to invest in it.
Okay.
Anything else?
Yes.
Let's see what time is it.
It's 7:50.
So about 5 minutes. Thank you. And how are your other workshops?
It went pretty fast, actually. Not bad.
You guys enjoying them? Learn a lot? How many of you guys, did you guys know a lot of the stuff we went over today?